five types of major accounts is asset accounts, liability accounts, equity accounts, revenue accounts, and expenses accounts. First, asset accounts, where you record things that the business owns. For example, let's say an agriculture company purchases a land for $100,000 in cash. In this example, the company will account for both an increase and decrease in assets. Why? Because the purchased land is non-current asset and the land account of the general ledger will be debited with $100,000. At the same time, the company's cash or the current asset is decreasing in value and the account will be credited with $100,000. Second, liability accounts, where you record debts that the business owes. Balance sheets used to be written out in two columns. The left column would be reserved for assets, while the right column was always reserved for liabilities and equity. Here's a balance sheet of hypothetical business, Annie's Pottery Palace, written out in two-column format. See how Annie's total assets equal the sum of her liabilities and equity. That's not just a fluke. If your books are up to date, your assets should also equal the sum of your liabilities and equity. Accountants call the relationship the accounting equation, which is the most important equation in all of the accounting. You can write it out in equation from like this. Assets equal liabilities plus equity. If your assets don't equal your liabilities and equity, the two sides of your balance sheets won't balance. The accounting equation won't work, and it probably means you've made a mistake somewhere in your accounting. Third, equity accounts, where you record the funds introduced into the business and drawing by the owners. For example, if a retained earnings account has a debit balance, it might mean the company experienced losses or issued more dividends than it had to give. As an equity holder in company, you have voting rights to what decisions a company makes, like director elections or voting at a general meeting. The more equity you have, the more power you have. And conversely, the fewer shares you might own, the less power you have. Voting rights might influence how many shares you invest. Fourth, revenue accounts, where record money received by the business. For example, Coca-Cola has set up 5 factories in Pakistan. Each factory produced and sold 30,000 units in May 2020. The unit price of each product is sold is Rs 25. What is Coca-Cola's revenue? As per the above example, revenue earned by Coca-Cola is 3.75 million. As per the above example, revenue earned by Coca-Cola is 3.75 million. 30,000 multiplied by 5 equals 150,000. Then multiply it by 25 and 3.75 million. Expense accounts, where you record money paid by the business. An expense is a cost that businesses incur in running their operations. Expenses includes wages, salaries, maintenance, rent, and depreciation. Expenses are deducted from revenue to arrive at profits. Businesses are allowed to deduct certain expenses from taxes to help alleviate the tax burden and bulk up profits. Number 2 question. What is current and non-current assets? You are very thirsty and someone offers you either a glass of water or a glass of ice. Of course, you gladly accept the water, even if you're hot, because it will immediately quench your thirst, while the ice takes too long to melt. So, current assets are those that you can convert into cash within 1 year, such as short-term investment and accounts receivable. Some examples of current assets include cash, cash equivalents, short-term investments, account receivable, inventory, supplies, and prepaid expenses. The non-current assets are longer-term assets with a full value that you cannot recognize until 1 year. Number 3 question. What is current and non-current liabilities? Current liabilities are the obligation due for payment within the next 12 months. The liabilities are long-term obligation including debts of the business are not for payment within next financial year. Current liabilities obligation that will settle by current asset or by the creation of new current liability but do not accounts payable are due within 30 days and are paid within 30 days but do often last 30 days or 60 days in some the loss from the late payment accounts payable non-current liability payment may not be due with it's important a business doesn't overlook its non-current liabilities. It may still have to make payments toward a non-current liability. Non-current liabilities are important part of a cash flow forecast. By comparing non-current liabilities to cash flow, a business can see whether it has ability to pay its future debts and grow. Number 4 question. What is account title? Account title is the unique name assigned to an account in an accounting system. An account title is essential when the accounting staff needs to identify an account, since the title conveys the purpose of the account. The other unique identifier, the numeric account code, may incorporate some identification logic, but it has much more difficult to associate with a specific account. Without an account title, the possibility of making an incorrect entry into the wrong account would be much higher. Number 5 question. What is charts of accounts? A chart of accounts or COA is a list of all accounts you must use to record financial transactions in your general ledger. It helps you keep track of where money comes from and goes. A chart of accounts is integral to your bookkeeping, accounting, and financial reporting. They're like a map that helps you categorize your transactions correctly and group similar accounts together for reporting. My overview of statement of financial position. In financial accounting, a balance sheet, also known as statement of financial position or statement of financial condition, is a summary of the financial balances of an individual or organization. Whether it be a sole proprietorship, a business partnership, a corporation, private limited company, or other organization such as government or not-for-profit entity. Assets, liabilities, and ownership equity are listed as of a specific date, such as the end of each financial year. A balance sheet is often described as a snapshot of company's financial condition. It is the summary of each and every financial. It is the summary of each and every financial. My overview of statement of comprehensive income. It contains those revenue and expense items that have not yet been realized. It accompanies an organization's income statement and is intended to present a more complete picture of the financial results of a business. It is typically presented after the income statement within the financial statement package, and sometimes on the same page as the income statement. And sometimes on the same page as the income statement. A smaller business with relatively simple operation may not have been engaged in any of the transactions that have normally appear on a statement of comprehensive income. If so, they don't need to produce the statement. Thank you.